Hey, what's up guys, it's Moza Man here. Now it's no secret that the economy is struggling and experts are saying that we are heading for the worst recession in almost 300 years. Business profits are down, companies are not expanding, people are losing their jobs, and the stock market, well, the stock market is, going up? What? That's right guys, after the initial crash back in March, we have seen a steady rise in the stock market since then, even though we are still in lockdown. However, there is talk of a second wave of the coronavirus hitting the UK, and that's obviously going to have an effect on the stock market. But overall, the stock market is on an upward trend. So what's actually going on here? In this video, we try to go through the different reasons why the stock market seemingly looks to be recovering, why the economy is struggling, and we are still in lockdown. As always, guys, if you like the sound of this video, smash the like button. It really does help out with the YouTube algorithm. Also, if you haven't already, subscribe to our channel. You have no idea how happy I get when I see a new subscriber. So if you could do that, it would be really appreciated. So guys, before we get into the specific reasons, we want to understand one thing, that the stock market is not the economy. Okay, I'm going to repeat that. The stock market does not equal economy. They're not the same thing. The best way to remember it is when we're looking at stocks and the stock markets in general, it's a forward-looking view. Okay, when I mean forward-looking view, I mean whenever someone puts up their hard-earned money or invests their money into a stock market, they're expecting that money to grow in the future. They're expecting that company to do well and post good profits in the future, and they've got their company to expand. All these things that go through an investor's mind when they invest into a stock market. Okay, it's forward looking. Hopefully in the future, 1, 2, 3, 4, 5 years down the line, that company is going to be performing very well and has expanded, and in return you have gained good value on your stock. So the economy is completely different. The economy is not forward looking, the economy is backward looking. We're looking in the past, we're looking at what's happened and what's currently happening. Okay, so that's a key thing to remember. The stock market is forward looking, the economy is looking in the past. It doesn't mean that the economy does not affect the stock market. It does indirectly. It does. So for example, if a company posts bad results, they didn't make enough profits, then it will in turn have an effect on the stock value, because what people will tend to do is to sell their stock when something goes wrong. But you have to remember that the stock market is only affected by one thing, and that is the buying and selling of shares. And the buying or selling shares are done by people. And remember, people are emotional, people are irrational. They make decisions based on stupid things, not necessarily on hard evidence or hard facts. Like, if you want a really good example of that, then look at Uber. Go look at Uber's history. So Uber is one of those big companies that, has, I don't know if they ever have posted a profit. They're continuing to post losses and losses, yet their share price keeps going up. And the reason that is because people believe that Uber is going to post massive profits when it eventually gets, when it sorts out all the bumps on the road, etc. So people have so much belief and so much confidence in this company that it's going to eventually return good on their money, that they continue to invest regardless of it performing badly. Right, now let's go through the reasons why we believe the stock market is continuing to recover while the economy is struggling. So the first reason is bouncing back from record lows. So guys, if you remember back in March, not too long ago, back in March, we did first hear about the coronavirus coming into Europe, and that obviously affected our markets. We saw a massive stock market crash. Right? It was actually worse than the 2008-2009 housing market crash that we saw not too long ago. And what happens usually straight after an event like that is it becomes a massive buying opportunity for people to get in and buy cheap shares. And that's basically what we saw. We just saw a very predictable bounce back, and we saw loads of people pouring in their money, investing into the stock market, and looking for cheap shares. And that's totally normal. That happens to all the markets. If you look at the S&P 500 in the US, same thing happened there. If you look at our market, the FTSE 100, FTSE 250, same thing happened there. If you look across to Europe and other markets, the same thing. Asia, same thing. Every time you see a massive dip, a crash, there is going to be a predictable bounce back. I would like to obviously call out and warn people that although we've gone through this bounce back and we seem to be on an upward trend, if there is, and they are saying that there's a second wave of the coronavirus coming, then that's obviously going to have another impact on the stock market. So we will see probably another dip or another crash of the market slightly once that news comes out. So even though we're going to go for a second wave of the coronavirus, I don't think in any way possible it can be as worse as the first one. We're definitely much more well prepared this time. We're probably going to see another market crash. We're going to see the economy struggle even more. That's all true, but it will be a lot better than the first time round. So I genuinely think that even though we're going to see a stock market dip, it will still continue to recover and there will be a slight upward trend. The only thing that does worry me is the fact that when we do start seeing companies start posting their profits, at the end of the year, then that could have a massive effect on the stock market. So when these companies come out and start saying we've had a terrible year, we've only profited this much, or we've lost, and we're going to have to start cutting employees, we're going to have to start cutting back on costs, we're going to stop expanding, etc. That is my worry, what people tend to do. And again, I say people are irrational, not always thinking long term. They think quite emotionally sometimes. A lot of times people will probably start panic selling at that point again, which will cause another dip in the market. But obviously nobody knows what on earth is going to happen. A lot of people are saying that this is not a fundamental issue with the economy or a fundamental issue with any company. It's just unfortunate that this has happened, so hopefully we should pick up pretty quickly. But nobody ever knows. Nobody knows what the stock market is. All you can really do, the best thing you can do, and the best advice I would give you if you're thinking about starting your investment journey, is to just invest consistently, invest over a long period of time. Don't just put all your eggs into one basket at one point in time. For example, if you've got, say, £100,000 you want to invest, don't chuck the entire £100,000 and buy all the shares today. Spread it out a little bit, and that will save you from a lot of volatility in the market, and hopefully you'll be able to prosper long term. Right, so the next thing we want to talk about that is probably helping the stock market recover is the cutting of interest rates by the Bank of England. So the Bank of England has been cutting interest rates quite drastically during this whole pandemic. It's gone down from 0.75% to 0.1%, and that's all in an effort to stimulate economic activity. So how does that work? So basically what happens is, firstly, people who hold their assets in cash form, for example sitting in the bank, who are quite happy previously to just earn interest on that money, are now likely to start taking that money out and start spending it or investing it. They'll start looking at the stock market, they'll start looking at the property market and elsewhere, because it doesn't make that much sense anymore to leave the money in the bank account and in the interest, which is very little right now. What it also does is that borrowing becomes cheaper. So if you're going to get a mortgage, the interest rates are lower, so you'll be paying less interest. If you're going to get a loan, that'll be less interest too. So this encourages people to go out and spend more money that way and invest more that way. What also happens is that banks will actually start making less money this way, so they are now encouraged to lend more money. So all these things together help stimulate the economy, which in turn has a positive effect on the stock market. So the next thing we want to talk about is the government pumping billions and billions of pounds into the economy. So we've heard about the furlough scheme that the government's come out with that is paying up to 80% of people's wages, which is absolutely brilliant. I think in some cases I've heard that people are getting the 80% from the government and the employers are topping up the next 20%. So you've got a whole big proportion of the population who are probably getting up to 80% of their wages and actually not doing any work, sitting at home doing nothing. You've also got a big proportion of the population who are working full-time from home. Also, given the fact that both the people who are just sitting at home doing nothing and the people who are working from home, we're saving a ton of money. We're not spending as much going out, we're not spending much on commuting, we're not just spending much in general. So people are more likely to invest now more than ever. And the stock market is such an easy way to get started, because if you think about it, if you're going to invest in a property, you still need to go and view that property, you need to talk to estate agents, you need to line up solicitors, etc. So there's a lot of work that still goes into investing in property. But the stock market is completely different. You can get up and started and investing within minutes. All you need is a phone, all you need is an internet connection, and that's it. So I wouldn't be surprised if you've seen a big proportion of the population investing more money into the stock market, which is helping this recovery. Which is why I stress, when you do start investing your money, if you're not someone who's a trader, if you're not in the banking industry and know this stuff inside out, then stick to the basics, and that is investing consistently over time. You look at your investment as a 5 to 10 year plan. 10 year is the optimum, because in 10 years, this will be a minor blip in the road and you'll be so glad that you got invested at this time, because you're probably buying shares on the cheap right now. But invest consistently. Don't invest in your entire savings right here, right now, because you probably see a drop in a couple of months' time and get really, really worried and get scared and probably sell it. Don't do that. Okay, invest consistently, invest over time, invest over the 10 years. Put like £1,500 a month or something like that into the stock market every month over the next 10 years and see how it works out. Anyway guys, I hope you enjoyed this video. If you did, leave a comment, smash the like button, subscribe to our channel. See you guys next time.